Now, ERShares CEO Joel Shulman. Joel, what do you make of the action in this market? And we were talking about it in the break. It seems like investors were counting on the Federal Reserve to get it right and manage a soft landing. And based on history, never happened in 80 years when the Fed tried to lower inflation to 40%. So they're waking up to the fact that a recession is coming and that inflation is not anywhere under control.
No, you're absolutely right. And we talked about this 8 months ago when I was on your show. You were anticipating many of these actions today. And we're seeing many of the leading indicators now showing recession, seems to be more likely. I mean, we're seeing building permits down. We will see probably unemployment, ticking up. It's just starting. We're still at record levels, and that's kind of kept the markets buoyed. But the rising levels of food prices and energy costs being high, impinges more heavily on the poor, and so we're going to see some fairly significant problems with our economy going forward.
What are the problems, Joel? Well, let's talk about diesel. So diesel hit a new all-time high yesterday. Why is diesel so critical? And I know I repeat myself, it's the fuel that moves the economy. Anything that travels on a train, a truck, a ship, and like the entire farm economy, or about 2/3 of it, runs on diesel fuel. So when diesel's at a record, that continues to feed through to goods and services from coast to coast, far and wide. And that's why it's still so troubling that diesel, today's not a new record, but it hit a new record yesterday.
Well, and you've been talking about diesel for a long time. In fact, you were one of the early expressing early concerns about this. And as you say, I mean, we started this problem with demand pull with COVID, and now we're in a cost push cycle. And as you describe, I mean, it feeds into everything, and it goes into just more than just shipping costs. And we're seeing many of the retailers now suffering largely because of the transportation, and they're being stuck with unsold inventories. We're seeing costs going up, and so we're seeing even the financials with SG&A costs, with their employment rising. And this is continuing to fuel everything. And so when you're in a cost push scenario, which we have now, and this is what we had in the 80s, becomes problematic because usually the only way you can slow that down is through contraction or a recession. We're not there yet, but we're seeing early signs. We're seeing more and more signs that this is impending, and we're seeing that the economy slow down. When we have 2 negative quarters, then we've got an official recession.
Right, negative in the first quarter, and the GDP now forecast, which from the Atlanta Fed last week, that was on June 8th, is at barely growth of 0.9%. Joel, you were talking about this, that companies are warning earnings are under threat, under pressure, predicting results will be lower than expected after forecasts were trimmed across sectors. So Microsoft and Target warned results will be lower than expected, and that's something that, again, the investors seem to be catching up on.
Well, it's interesting when you talk about Target and companies like that, the other staples like Walmart and even Coca-Cola. If you look at their graphs, so some of your listeners will look at the graphs, and they see that they were flat for about 30, 40 years, and they spiked up the last 2 years, so they look like growth stocks. In fact, on a price-earnings growth ratio, they're actually 3 times higher than high-growth stocks like NVDA. So what we're seeing is many people pursue the staples at all costs, and they've actually priced them higher than the growth stocks, which are under pressure.
Mike Lee, jump in here.
Yeah, hey, Joel.
Hey, Mike.
So the economy is slowing dramatically. We have in a very ugly equity markets out there. And historically, as an economy is slowing like this, you have the Fed stepping in to be accommodative, to help the overall markets and the economy in a quote-unquote smooth landing. But we're about to embark on one of the most unprecedented tightening cycles, given the size of the balance sheet, and that we're looking at a minimum 50, most likely a 75 coming this week. What do you think stems the tide for stocks going forward?
Well, good question, Mike. I mean, we're seeing a number of companies that are falling victim to rise in SG&A costs, and so they have to get their costs under control. And as I'm sure you're aware, that many of the tech companies in particular are under pressure, largely those that are high growth and that have losses. And the VCs have already told the nascent companies, those that are not yet public, you got to cut your costs right away. So what we're going to see are the companies that are going to survive and possibly thrive in this market are those that are able to contain their costs. And we're seeing over the last few years only a handful handful. In fact, I did some research last night, 56,000 companies. Only a handful have SG&A costs going down and expanding margins. I mean, this is very common, 2-3 years ago, but we're seeing very few now. And in fact, what we're also seeing are many of the company leaders, the executives, they're going to start coming under pressure because they were taking, in some cases, $50 to $100 million, in some cases, hundreds of millions of dollars. There were a few people who took more than $300-400 million in compensation, while the stock was plummeting 50, 60, 70% last year. And those companies in particular are going to be under pressure, I think, in the very near future.
Before we go, tell the viewers what SG&A stands for.
Oh, I'm sorry.
Okay.
Sales and general administrative expenses. So you have the top line gross margin, and then you have the sales and general administrative expenses, and so then you're left with what's considered the EBIT margin, earnings before interest and taxes. And so the SG&A, or the costs associated with management expenses, are going up, and that's what's fueling a lot of the problems.
How much do you think the Fed hikes interest rates by the end of the year? We were talking about, Mike thinks it'll be 75 basis points this week.
Yeah, it could easily be 75 basis points. And we're seeing a lot of interesting things. Well, first of all, the Fed is trailing the markets. I mean, the market's already showing long bond over 3%. And what's interesting is when you think about the 30-year mortgages, they went up 2 to 2.5% this year. The long bond, or the 30-year Treasury, only went up about 1%. So it's got more room to move. And I think it's probably going to be over 4% by the end of the year on the 30-year bond.
Because to kill inflation, technically, your Fed funds rate, short-term interest rates need to be above the level of inflation. So you think about inflation north of 8%, and that will make you quake in your boots. Good to see you, Joel.
Good seeing you. Thank you.
Joel Shulman, thank you so much.